All right. Well, you know what? I think we could jump in. Before we do, just a few housekeeping things to go over, guys. We will be recording this. We'd love for you to stick around for the whole presentation. Obviously, we have a lot to share, and Sean's got some, a lot of value to offer. So we will be recording it, though. If you can't stick around, you'll receive a recording tomorrow. Without further ado, why don't we jump in, Sean?
Yeah, sounds great.
Okay, cool. So today we're talking about the path to home ownership, and we want to talk about, what's happening with buyers in today's market. Try to create a little bit of clarity around what we're seeing on the ground floor with the market, and really help home buyers and soon-to-be buyers, first-time buyers, repeat buyers really understand what's available to them in today's market and what the landscape looks like. So, before I introduce myself, Sean, why don't you give us a few words about your background?
Yeah, I'm a mortgage broker at Dominion Lending Center's Edge Financial. I specialize in helping first-time home buyers with their mortgages. Just love that process of helping somebody get their first home. I work with about 40 different lenders, including some of the big banks, some credit unions, mortgage finance companies that compete with the banks and credit unions. And for most people, it's a free service. I get paid from the lender. And so it's one of these, hey, I'm going to help you get a great rate, provide you some great service, and get you on your way to home ownership.
Awesome. For those of you who don't know me, my name is Ryan Coyle. I am the founder and broker of record of Connect.ca Realty. Connect.ca is a sub-brokerage of Royal LePage Signature, which is the leading Royal LePage brokerage in Canada. That's an important thing because what it does is it supports me and my team. It gives us incredible access to incredible data, resources, admin support, marketing support. And it's really been what's helped us really create a lot of business and a lot of success for me and my team. This is a picture of my team right here. I've got to actually, did I just mess up my presentation, or are we still good? I had to zoom in.
Yeah, still good. Looks great.
Okay, cool. So this is a picture of my team. They're an absolute rock star team. I've got an admin team, a marketing team, and my sales team here in the background. You probably heard them on the phone. They probably called you guys a number of times. They're great to talk to. We're really just trying to reach out to all of our leads, all of our past purchasers and clients to really answer any questions they have about the market and share really great opportunities. I'm proud to say that we've been able to help over 3,500 clients over the last 20 years we've been in this business, and have done over $2 billion in transactions over that time. I'm going to quickly go over the agenda. I know I've got a guest on here, Sean. He's got a lot to talk about. So I do want to do a quick market update. We're receiving a lot of questions about the current market. There's been a lot of announcements and changes that we want to address. So I'm just going to do a quick market update. Then I'm going to hand it over to Sean to really talk about mortgage insights for home buyers. And then at the end of this, we're going to invite you guys to an open house. We'd love to see you guys in person next week. We're hosting one at a development site where we've negotiated a really incredible deal with the developer. It's going to allow us to meet face-to-face, talk about that deal, answer any questions about the new HST rules, and really share information about the opportunity in the market. So 2026, this is what I'm calling the corner year, and every market has a turning point, and it's not where prices spike, but it's where the conditions that held people back start to reverse. And I thought 2025 was going to be a corner year, but then we saw a lot of changes happen, which we'll get into. But the market goes up and the market goes down, and I think what we're seeing right now, for a number of reasons that I'll get into, is we're turning this corner. We've scraped bottom for a period of time now, and we're starting to see the triggers in effect that actually move the needle into a more positive market. And affordability is really what drives the market. So what are the three forces that drive affordability? And it's really when incomes are increasing, prices are coming down, and rates are coming down. And over the last few years, we've seen incomes consistently go up, outpacing inflation. We've now seen prices drop considerably, down roughly 8% year over year, nearly 30% from the early 2022 peak year. And we've now seen rates come down significantly. So if affordability has genuinely improved, why aren't buyers moving off the sidelines and moving prices higher? Well, demand is driven by consumer confidence. And what really drives consumer confidence? I mean, it could be policy, it could be rates, it could be taxes, a number of different things. And the real driving factor behind demand over the last 3 years have really been mortgage rates, which Sean, I know you'll cover in more detail. But what happened? The government increased rates to cool inflation, to cool housing prices, and the prices went all the way up here from low rates. And then there's an inverse correlation. As rates are going up, prices are simultaneously going down. And what was interesting in early 2023 is when we saw the government pause for a few announcements and rates just went sideways. That actually spiked a bunch of people off the sidelines, and it increased consumer confidence, and prices therefore went up. And we're now at lower rates than that temporary period, but we're not seeing that same amount of demand and consumer confidence come back into the market. So it's really driving it right now. And going into 2025, as I mentioned, I thought it was really going to be a year where we're going to see a lot of positive things happen in the market. And then we had a snap election here in Canada. It was something that was unexpected. Down south, we had an election with the US government, and we all know how that's gone. That led to tariffs, it led to trade war uncertainty, it led to geopolitical instability globally, which is uncertainty, which drives, obviously negative consumer confidence. The war that's happening in the Middle East is just, awful for so many reasons, but that's now driving up oil prices and adding to further consumer confidence issues. And what really drives consumer confidence? I know when I was, starting in real estate, when we had a bad market, I would just stop watching the 6 o'clock news, or I wouldn't turn on or I wouldn't pick up a newspaper. But now every time I pick up my phone, I'm seeing things that, aren't usually that positive. It's usually negative news, and it's really unavoidable. Everything's under a magnifying glass. So that's really driving a lot of the consumer confidence at a really high level. Now, I'm starting to see positive signs emerge, and I'd love to know what you think if you're seeing similar things, but it's not going to show up in the March data because the last week of March was a real anomaly. We saw a ton of buyers come back in the market. I can tell you guys that my team is on the front lines working with dozens of buyers, and where properties typically took 45 plus days to sell, good condos, good resale houses in the right neighborhood at the right price were selling in a matter of days, and many of them had multiple offers. So it's something we want to watch closely. This could be just a little bit of maybe demand from January and February that buyers were already planning on entering the market, but because of weather, maybe they sat on the sidelines and they started coming back as the weather got nice. Or maybe buyers are starting to realize, look, we're at the bottom. Prices are not going lower, and now is a really good time to buy when prices are still affordable for all the reasons I just went over. So it's something we want to watch closely, and we always update you guys via email updates, what we're seeing on the front lines. Now, pre-construction, has been an anomaly. I haven't seen it this active in the last 3 years. The government obviously made a huge announcement, which I'll go into more detail about later, but our phones are blowing up. We're seeing people that, weren't even thinking about real estate 2 weeks ago that are now meeting us at developer sites to buy and take advantage of what's being offered. So we're starting to see that shift. Now, is it going to be a long-term shift? Time will tell. Another important thing to note as well is that TREB has noted that they believe there's 100,000 plus buyers that are actually ready to buy. And this was done through a survey they did, but they're just waiting for the right time. So again, the question is, when is that right time? When is confidence going to come back in the market and move those buyers off the sidelines? So it's not a question of if, it's a question of when. Now, this is a really interesting slide. So last year, the GTA market saw 62,000 sales, which is comparable to the next lowest year, which was in 2000. So it was 61,000 sales in 2000 compared to 62,000 in 2025. The difference is there's 40% more people now, meaning there's 2 million more people in the market than there was in 2000. So again, there's the same sales volume, 2 million more people. That is pent-up demand. The question is when, not if. Now, on the demand side, for a number of reasons, it's tough to really obviously know when buyers are going to come back, because we'll see it on the front lines. We'll see things tick up, and then we'll report it to our real estate boards as sales happen, and then the real estate board will report it to the news, and things kind of have a bit of a lag factor there. But what I can tell you on the supply side is the data is available. So this is where it gets really interesting. And as you guys all know, prices have to do with supply and demand. So this is why prices are going up and down. It's when there's an imbalance between supply and demand. Now, on the supply side, this gets really interesting. 2025 saw only 5,300 new home sales. That was the lowest number in 45 years of record keeping. So the lowest number ever. And the 2 or 3 years, probably 3 years before that were also previous record low years. So what does that mean for new homes? Well, I think the government admitted in this most recent announcement that we actually need buyers to buy new homes, to create new homes, because the government's not doing it. They just admitted it. That's how I read this most recent announcement regarding the HST rebate, which I'll talk about. So what that means is buyers, mom and pop investors typically buy pre-construction, and then the building has to sell 70 to 80% in order to get construction finances to start construction. And then it takes 5 or 6 years to get it built. So from the start of sales to build. So that 5,300 units that's sold, I can tell you in the majority of the buildings those were sold in will never get built because they're not going to reach 70 or 80%. So what that means when you look at these numbers, take a step back, 2024 and 2025, those numbers are locked in. We know we had roughly 30,000 new condominium completions in those years. Simultaneously, this is when rates spiked and buyers disappeared. So we had a record amount of supply and we had a record low amount of buyers demand. But this is where it gets interesting and important. 2026, there's a projected 20,000 units to be completed. I can tell you with certainty this number will be a lot lower. And the reason is not all of these will actually get built, and a lot of these will actually be delayed. So realistically, and I'll look back at this in a few months, or I guess 8 months, 9 months, and I'll see if I'm right. But my guess is we'll see roughly 15,000 new completions this year, which is roughly half of the last 2 years. And what's important to note with this as well is a lot of those completions are going to happen in the 905. 416 will actually see a lot less supply be added starting this year compared to the outskirts of Toronto proper. So you'll start to see prices stabilizing and tightening in that market, I believe, first. But this is where it starts to get really interesting. In 2027, there's a expected 15,000. That number will be closer probably to 10, 12,000. And then 2028, that'll be below 10,000. And then as of 2029, that's relatively zero new condos being delivered. So if we know that it takes at least 5 or 6 years for a condo building to sell out, if a condo project sold out in today's market, which would never happen, it would take 6 years by 2031 for us to start seeing supply being added to the market. So we're going to have supply going down for the next 26, about 6 years, as we have buyers going back in. So, what is that going to do to prices? I don't want to answer that to you guys. This is a really important question for you to ask yourself. But we know that buyers are piling up over here. We know they're entering back into the market, while simultaneously we're going to see record low supply. And we know why the real estate market as a whole has been so strong over the last 25 years. It's simply because we haven't had enough supply. So the HST rebate, and Sean, jump in at any time if you have anything to add to this. It's a funny thing because politicians tend to show up in front of cameras and news crews with big, nice ties, and they love to announce big, exciting things, but they don't always have all of the details finalized. And this is one of those moments. So, there are a lot of things that we are certain of, but I can tell you that developers, their lawyers, their accountants, they're still trying to work through the nuances of it to see how it's applied to all of the different scenarios. But what I can tell you with certainty is this is how it works. There's going to be a 13% rebate up to $1 million. So if you buy a $500,000 condo, you're going to get a 13% rebate. It's all prices across the board. Any condo, or I shouldn't say condo, any new home, to be clear. Any price between 1 million to 1.5 million, you're going to receive the maximum amount available, which is the 130,000. Now, once the purchase price goes from 1.5 to 1.85, it's going to be declining. There's a sliding scale, which they have not released yet. So I don't know exactly what that looks like, but it'll decline all the way to the point that when you get to 1.85 and above, you'll receive the existing rebate that is available of $24,000. Now, this was put into place as of April 1st of this year, last week, and this is available until March 31st next year. So it is 1 year. Now, this applies to all buyers. Originally, the feds released this to just first-time buyers. Didn't move the needle. No one did no buying. It didn't change anything. So the provincial government, the Ontario provincial government, worked with the feds to have them agree to pay their portion on the amount above 1 million and 1.5. And this is now applied to all home buyers, first-time buyers, repeat buyers, and to rental properties. Now, we're still finalizing this, but I believe this will only be long-term rentals, which is already how the $24,000 is applied. It does not apply to short-term rentals. It only applies to rentals that are 12 consecutive months. So we'll release more details as we start finalizing. I can tell you what developers are doing with this is quite incredible, and this is why the needle is really moving, is developers are doing one of a few things. So some developers are doing the discounts for you. So they're just building the discount into the purchase price. They're throwing a lot of price incentives in addition to that, a lot of incentives, a lot of rebates, and they're throwing in the kitchen sink. They've been sitting on a lot of sitting inventory for a long time, and they're using this as an opportunity to add further discounts to really start moving inventory, and I can tell you that it's working. Other developers, what they're doing is they're allowing you to purchase. A lot of them are offering discounts still, but not the full discount. And then you'll file the rebate on your own. Now, what that can look like is if you bought a home and put down 10%, and then you receive a 13% rebate, there's an incentive to want to be able to do that as a buyer. And I can tell you, we're working with a lot of buyers right now on projects that are only taking low deposits so that they can buy as an end user with little money down to no money down. As an investor, where this gets interesting, and some of our clients are doing, is they're going to, including myself, is I'll be buying and using this rebate to cover negative cash flow for many, many, many years until it's actually positive cash flow. So it's a really unique offering. The government really needed to try to stimulate housing because they're not doing it on their own. They're not building. And if condos aren't, or pre-construction homes aren't selling and creating tax revenue, why not just eliminate it and try to stimulate the economy, construction, and other things, and through just giving this incentive. So that was a mouthful, but it's a really exciting time, and we're really starting to see things move because of it. So I had mentioned this before. Some pre-construction properties are now effectively priced below comparable resale when you stack the incentives and the HST rebate. So like I said, developers are throwing in the kitchen sink. They're moving inventory. Like, things are flying off the shelf. If you guys are interested in learning more about this, I hope you can come out and see us next weekend or talk to me or the team. We'll share different opportunities with you. But now is an unbelievable time to buy pre-construction for a number of reasons. Now, before I hand this over to you, Sean, I always like to share this with our clients, especially in a market like this. We're dealing a lot with parents that are investing in their children's future. So, real estate in the GTA especially has not always been affordable. We know affordability has improved a lot. In fact, affordability, which is interesting, is the same as it was in 2021 when prices were ripping, although things are still pretty distressed right now. So I want to share this example. A $500,000 condo, if it were purchased today with a $100,000 down payment, would cost roughly $2,500 per month in expenses. Now, if you were to rent that same property, you'd be looking at about $2,300 a month in rent. So over 10 years of renting, that would cost roughly $320,000, zero equity built, zero wealth created. If you were to do the buyer route over 10 years, you're going to save $320,000, and you're going to earn roughly $400,000 in equity. Now, that's really important. That's the difference between And I'll share my example in a minute, but I'm living in my dream family home. And had I not been an early purchaser with the help of my mother, I would not be able to have the real estate portfolio that I have today, let alone my family home. So it's really important to set yourself or your children up for success early on. And this is just a really a simple example of articulating. And again, the reason why I use this example is, first of all, it's had a huge impact in my life, but these are most of the buyers we're currently dealing with. And it's parents that are really trying to set up their children for success in the future. So I'll just end off with my story, which I kind of alluded to. This is a picture here of my family, my father, mother, my sister, myself. I was probably about 3 years old there. These are 2 rental properties that my mom and father owned at a very young age. And tragically, I lost my father not too long after this picture was taken. And the reason why I share this story is because what real estate was able to provide to me and my family was truly extraordinary. My mother was an exceptional mother, very loving, very caring. She was on a single income as a teacher. And what she was able to provide to me and my sister with the vacations, playing all the sports, the nice bikes, everything she provided was truly incredible. And real estate was part of that story and was able to provide for us. She went on, she bought more property. There were positive cash flow. I remember driving around at the earliest age in the back of her car. Strangers would hand her cash or checks through the window every month, I should say. And I didn't really understand what was happening. And I later understood that those were in fact tenants paying off her mortgage. And that really stuck with me at a young age. And really that's where it all began with me. This, if you guys remember this ugly bungalow from the previous slide, my mom sold that property when I was 20 years old. So roughly 25 years ago. And she took the equity from that property and she bought my sister and I a condo here in downtown Toronto. That was about 25 years ago. And that condo set me up for what I've been able to accumulate today, the wealth I've been able to accumulate, mostly through real estate. That was the first property I had owned. My sister and I lived there for about 2 or 3 years. We went on and my sister got married, moved to Brantford. She bought her own family home. She ended up buying an investment property. I moved to Leslieville. I bought a house there. I bought a second investment property. And I just kept refinancing and buying and more. And for those of you who know me, I've accumulated a portfolio of over 40 doors. So that is really where it all started for me. And I've been able to refinance my properties to buy the home that my family and I live in today. So I just thought that was a really important story to share because I'm seeing more and more parents want to do the same for their children. And this is really an example of how powerful it is. So without further ado, Sean, how long did that take? I'm always curious.
A little over.
Longer. I timed myself earlier. I thought I was flying through. Shoot. So.
Yeah, you were moving. It was great. Really inspiring story, Ryan. I don't think I've ever heard that you tell that before. So that was great. Just in terms of like the inspiration of like getting into the market, I see where that has all come from, and to be able to build that portfolio is super exciting and like really inspiring.
Thank you.
So I just want to share a few things. This is actually a seminar that I did on Monday as well. So I'll skip through. I'll try not to be redundant in some of the things that you covered already in terms of the market. I'll just hit on a couple of things. I think you did a really good job of covering that. I said at this front, I'm Sean Humphreys. I work at Dominion Lending Centers Edge Financial. We're actually affiliated with Ryan's, the parent brokerage, Royal LePage Signature, which is owned by the same brothers that own our brokerage. I work with I've been doing this 10 years, worked with a lot of different home buyers, first-time home buyers, investors. I also live, you mentioned Leslieville. I'm not too far from there. I'm actually in Riverdale myself. So just around the corner from where you were anyway. So I actually usually ask, like, how many people are first-time home buyers? It's not a very good, we're not going to be able to answer that here, but I think the majority of people are looking at that. Ryan, you cover this already. I'll just go on a couple of things here in terms of, is this a good time to buy? So, I always like looking just at the simple, well, what's the price right now? if we look at the top of the market here in 2022, the average price on MLS was 1,339,000. And I equate that to being this is Christmas Eve. The mall's closing in an hour. There's not a lot to choose from, and nothing is on sale. And that's really where we were at. And it did have that sort of frenzy sort of feeling where, geez, I got to buy something before I'm not going to have anything tomorrow. My kids will never be able to buy something. And I love how that perspective has changed now, where there is an opportunity for parents to help their children. And also to feel like it's more of a relaxed and more sophisticated way to buy rather than just showing up with the biggest bag of money and hoping that you get the property. And now we're more into, 2026 is more like Black Friday at this point. Lots of things for sale. There's lots of supply. Things are on, you can buy what you'd like and take your time. It's a couple of days rather than, you've got an hour. And so there's just a different perspective in the market as well. One of the other things I like to look at is what's the price difference? If you look at 2022, how high, the average detached property was somewhere around 1.8 million. And the average condo, if you can believe it, was actually almost 800,000. It actually seems like so foreign now that the price was up that high for condos, considering we've dropped down to condos around just over 600,000 and the average detached property is 1.3 million. If you look at the price difference from 2022 for a condo and a detached home, it's about $1 million. And now the average difference is about is $700,000. So if you just look at, the upgrade cost of going from a condo to a house, there's never been a better time to upgrade. Well, it's a lot better than it was 4 years ago when we were at the peak of the market.
Yeah, that's an important point because, in this market, it sucks to sell a property at a loss or not as much as you thought it'd be worth. But if you're up buying in this market, it's better to get a discount on a more expensive property and then take a hit on your own.
Yeah, because those sale opportunities don't come along all the time. And I know it sucks. People, you put your money into a condo and you think it's going to appreciate. Maybe it's flat, but you've gained equity. You've maybe paid down your mortgage. You can now make an upgrade with you probably make more money than you were making before. And also maybe you could just rent out the existing property and upgrade to a house. There's not many better opportunities than there are right now for that. Yeah. So at the end of the day, the market conditions do favor buyers. And I don't know if I'm sure you know who this guy is, Warren Buffett, one of the greatest investors of all time. And one thing that he says that really resonates with me is be fearful when others are greedy and be greedy when others are fearful. And right now, there's a lot of demand on the sidelines and a lot of people are worried about making the wrong choice. And that's where there's a lot of fear in the market, a lot of uncertainty. And so if your finances allow it, now's the time to take advantage of some people. Chris Slightum always says this, there's some screaming deals out there right now.
Yeah.
And Ryan, you covered this already, but while you're waiting, you're paying rent every year and your property could be appreciating. You went into pretty good depth on that already. Getting on the property ladder, you get on at rung one, which might be a condo. You allow that appreciate. Maybe you get a townhouse, maybe you get a detached. You start accumulating doors like Ryan has done here. This is, I realize some people might be watching this on their phone as well, but every day I'm using an app on my phone and I'm giving people an idea of how much they can afford. If you want to download that, I'll also send out the link as well if anybody is interested, but it's a way to really easy way to be able to determine, okay, for this property, what's going to be the monthly mortgage payments, or, if we chat, I can give you some tips on how to use it where, you can figure out what your budget might be on that property. A couple of rules of thumb. So this one at the top, I don't love rules of thumb, but I like to give people maybe a bit of a sense of what they'd be able to buy. And so I'll just walk you through a couple of these here. And please, everybody watching at home, I'm not providing you a quote. Please don't go buy a home based on these rules of thumb. This is just for everybody just to get a sense of where they might stand and be able to do some back of the napkin type of math. So if you think about like how much that you can borrow, what your purchase price might be, you could take your income, so if that's your salary, and multiply that by about 4.5%. Now, there's some interesting ways where it might be a little bit higher, can be a little bit lower depending on the interest rate. You take your income times 4.5 and add your down payment. That should be roughly what you could afford. So if your household income is $100,000, you multiply that by 4.5, and you've got $100,000 down payment, you should be able to afford in the ballpark of $550,000. Each $500 loan payment. So you can have, a car loan and student loan likely, depending on how much you make. But you reach a point or a threshold where every $500 per month in monthly debt commitments that you have is roughly the equivalent of $100,000 less than what you can borrow. So, as I said, you can have a car loan, you can have, some student debt, but it's when you start having multiple different loans. You have credit card debt and line of credit debt. Some people make that choice if they're just going to own a really nice car, $1,500 a month for this beautiful car. And that's maybe the equivalent of $100,000 less that they could be able to afford. So getting that balance right for your lifestyle is really important. And then if you're just looking at just doing how much is this going to be monthly? Your monthly mortgage payment is roughly $500 per month for each $100,000 that you're borrowing. Just to give you a really how much is this going to cost me per month? Credit scores. I'll just touch on this really briefly. A lot of people, I'm sure you've heard this, Ryan, like checking my credit score is going to sink my credit. There is a very tiny kernel of truth to that, where if you are checking with multiple different places, like a car loan, you've got a credit card, a store credit card, line of credit, those all count as different types of credit checks. That all together can sink your credit score only up to 10% of your total credit score. So out of 900, it could maximum sink at 90 points. But if you are just doing it for a mortgage, it's very unlikely that it's going to shrink it that much. The things that make the biggest difference are your payment history, paying your credit on time, and then not overutilizing your credit. And anybody with a credit score over 680 is going to get the maximum mortgage amount at the best rate.
That's good to know. So yeah, I've been told this over the years as well. So if you're looking to buy a property and you want to shop around, or you have a mortgage broker who's going to go to multiple different lenders, it's going to seem, or I guess appear as though it's just one application, and that won't impact your credit score. But if you're going to looking to get a credit card and then a car loan, then it's obviously different type of credit.
Yeah, exactly. And this is actually straight from Equifax. This is Equifax's slide here. So if you're doing it in a short period of time with a mortgage broker and the bank, within 45 days, it's calculated as one mortgage pull or one credit pull.
Interesting. And one quick fact, and I know you would never do this, but I once worked with a mortgage broker years ago who went and applied for a lot of different mortgages over a 3-month period. And it was seen by Equifax as too many. I mean, I think it was like 10. And I had no idea. I thought they went to 3 lenders. So I actually went back to Equifax and I reported that to them, and they removed it.
Oh yeah, you can flag things with Equifax. Like you can dispute things. It's not uncommon for them to have like a birth date incorrectly, like reversing the day and the month. Or if you're new to Canada, you might have gone from a temporary social insurance number to a permanent one. And that's also that can create 2 different credit reports. So it's actually fairly easy to get it flagged and get it resolved. But it can take a couple of weeks. So I always want people to, let's figure these things out now. Let's get pre-approved, and let's not figure this out when you've got like a condition of financing that needs to be resolved in 3 days. Let's figure out all these things well in advance. Down payment requirements. So if you're purchasing a property at less than $500,000, the minimum down payment is 5%. And I often hear this, oh, my minimum is 5%. Yes, but only to a purchase price of up to $500,000. If you're purchasing a property between 500 and 1.499 million, that becomes the minimum down payment is 5% of the first 500,000 and then 10% of the balance. So if you're buying at, for example, 750,000, is 25,000 for the first 500,000 and then 25,000 for the next 250, which would make the minimum down payment $50,000. Once you get over the $1.5 million purchase price, you need a minimum of 20% down. And then closing costs on top of that, you're going to have land transfer tax. I'll go into a little bit of detail on this later, but we want to budget at minimum 1.5%, and it can be higher than that depending on your land transfer tax.
This is where I get fired up because I see so much opportunity. So if you're a first-time buyer, actually you don't have to be a first-time buyer to get the 5%, but if you're a buyer and you're looking at buying a pre-construction condo for $500,000 with no closing costs, because many developers are doing no closing costs, and you're putting down 5%, and then the government's giving you a check back for 13%, the math on that is very interesting.
Well, that is interesting. I hadn't put that together before.
This is why it's getting super interesting, and there's an opportunity like we haven't seen in years. This is a gift from the government.
They're practically paying you to take sounds like they are paying you to get a mortgage.
It's a bailout. That's what it is.
Yeah, that's great. And I mean, it puts the property in the hands of, it's a bailout for consumers, which doesn't happen on this scale very often. So if you have less than 20% down, and I'm sure you get people that I have to have 20% down, like they have it in their mind, like I have to have 20% down because I want to avoid mortgage default insurance or through CMHC. It can certainly help you to get 20% down because you're going to avoid that. But if it's going to take you 2 years to save 20% down in that time period, one, this HST incentive is going to end in that time frame. And two, you're probably not going to catch the market. The prices keep going up. In a normal market, they go up roughly 6.8% over the last 40 years is what I've seen. So you would have to then save more than what you would today. And you're then also not getting the appreciation of the property. You're not building equity. So I would say if it's going to take you, hey, a couple more months and you can get to 20% or you can get some family to help you, great, do it. But if it's a years long project to get to that 20%, it's just not worth the wait. Closing costs. Sorry, Brian, you want to jump in?
Yeah, I have a question. I mean, I wonder if the down payment could be applied. So if a developer was giving you a credit on close, could that be applied as a down payment? Or would that be seen as a discount from the purchase price?
It's going to be seen as a discount from the purchase price because the lenders are going to want to see that you've got that down payment from your own sources. Right.
So where my mind goes, I'm always looking for a way to find a deal.
It's a beautiful mind.
Yeah.
So if you're buying in Ontario, you've got the land transfer tax for Ontario. If you're buying from Toronto proper, so the 6 municipalities, so this includes Durham and Peel, just in Toronto proper, you've also got the City of Toronto land transfer tax, and it's based on the property. It's based on the purchase price. Lawyer fees are going to be somewhere around $2,500. CMHC also has, so you pay that, but there's also then the provincial sales tax. So the CMHC insurance or the mortgage default insurance gets added to the mortgage, but the PST, Doug Ford's tax, that gets paid on closing. And I imagine if there's a rebate coming from the builder and it's coming at closing, then maybe that could cover some of those land transfer tax, some of any other costs that you might see that way. So I love to go through some actual properties. I put this together last week, and I'm always shocked at like what the prices are now. This was a property in Liberty Village, a condo, 1 bedroom, 1 bath, sold for $435,000. If you look at, so I'll just go through this sort of from the top left and go down. So if you're going to put 5% down on this property, it's going to be about $21,750. You're going to get mortgage default insurance added to the mortgage of $16,000, which is going to make the mortgage $429,780. The payment on that is going to be $2,150. You've got maintenance fees and property tax with $610. The closing costs on that is going to be $2,760 per month, or the carrying cost $2,760. So you would need a minimum income in that scenario of about $97,000. If you put 20% down, which is $87,000, there's no mortgage default insurance. The mortgage becomes $348,000. Payment total carrying cost is just under $2,500, and the income that you need is just under $72,000, or it's about $72,000. Land transfer tax is pretty low at $435,000. It's only $1,175 for a first-time home buyer. So there's about $8,500 in rebates that come, and that's applied to that. So without them, you're closer to about, I guess, $9,500, $9,600 for land transfer tax. But with the rebates, it's about $1,200. Another property in Pickering, a detached 3-bed, 4-bath, 2-car garage. This one sold the other day for $780,000. Looking at 10% down is actually something I wanted to flag for people. If you can get 10% down, you actually save on the mortgage default insurance because it's on a sliding scale. At 10% down, you pay less of a premium. A percentage of the premium is lower. Sorry. So you're going to save a little bit there. If you can get to 10%, I would suggest that rather than try, if you can save to 20%, great, but 10% is a good benchmark to get to. It really drops off the default insurance at that stage. Don't want to try to go through this quickly, but the mortgage then becomes $725. The payment total carrying cost is just over $4,000. Whoops. The minimum income would be about $156,000. 20% down is $156,000. Carrying costs in that scenario would be $3,800, and your minimum income is $121,000. So, not most people don't make $121,000 or $156,000, but if you're looking at a family home in Pickering, 3-bed, 4-bath or whatever it was, you're looking probably at 2 incomes. A lot of people can get to that range, either 156 or 121 as a couple. First time program. So there's a few things here. You can use up to $60,000 tax-free from your RRSPs, and that you have to pay back. So you could take, if you've saved $60,000 into your registered retirement savings plan, you can take $60,000 of that out tax-free, and then you pay it back over a 15-year period. You could also take out, so you can contribute up to $8,000 per year in your first-time homebuyer savings account. So now people are getting up to the stage that if they put $8,000 in every year, they've got about $32,000 plus any interest accumulation that they have. There's also the land transfer tax rebate, which we've talked about. And then as a first-time home buyer, if you have less than 20% down, now you can do 30-year amortization rather than 25, which actually really juices up how much you can borrow on a mortgage.
That's great. I didn't know that. How does the FHSA work again?
So every year you can contribute $8,000.
Yeah.
And it's pretty somewhat similar to how the RRSPs work, but you don't need to pay it back after. So you can contribute it. There's
a tax deduction.
There's a tax deduction, and then when you take it out, you're not paying tax on it as long as it's going towards your first home.
That's great. And then what if 2 purchasers are doing it? They purchase
both
together.
Do it. Okay. Yeah. So right now the max would be about $64,000 that you could pull from that. One other thing, I know you probably have another follow-up question, but you can actually move money from your RSPs to your FHSA. So if you have $68,000 in your RRSPs, you could move, and you haven't contributed this year to your FHSA, you could take $8,000 from your RRSPs, put it in your FHSA, and then take your $60,000 from your RRSPs and using $68,000 tax-free that way.
And is there any time constraints with that? Or if, I decide I want to buy a house next month, I could do it tomorrow and it doesn't really impact anything?
You would have to pull it out as your purchase with an agreement to purchase the property.
Okay, got it.
So a couple of ways that I'm sure there's some parents on here trying to get their kids out of their basement or off their payroll. So a couple of ways that you can help as a parent. I get asked about co-signing. So if you're going to co-sign on your child's property, one, you've got to be on title of the property and on the mortgage as a co-signer. So we're qualifying you. We're looking at your income, your credit, what other debt commitments you have, property taxes, mortgage statements. That is all included as a co-signer. So you're a full participant in that. The one thing I would caution with co-signing is that, okay, you've got, you're able to help them, but if they're not able to pay that mortgage on their own, how are you then contributing month to month on the mortgage? Are you sending them money because they're not able to qualify on their own? I also get asked about kind of the sister of the co-signing, which is being a guarantor, where you're not on title, but you are on the mortgage and you help them out that way. The majority of lenders, if you're using your income to qualify, are not allowing the guarantor situation. You do need to come on title if we're using your income to help you get there. Guarantors are mostly for, if you don't have great credit and you need somebody to come on, but you, as the individual borrower qualifies, but maybe the credit isn't so great. That's where the guarantor situation happens a lot, but it's much more rare than just the flat co-signing. And the number one way that parents help their kids buy is through a gift towards the down payment. You're not on title. There's no tax implications to it. You're just giving them a bag of cash and helping them to buy. That is the simplest way to do it. At maximum, we're probably looking for a bank statement showing you have the money in your account and a gift letter stating that the money is to go towards the purchase of the property. Next steps. For me, if you are interested in getting pre-approved, is booking a free 30-minute consultation. From there, you fill out an application. We can hold a rate on a pre-approval for about 120 days. And then you just pick out the home you want and away you go. That's it for my presentation.
That was great. Thanks, Sean. Appreciate that. I actually learned a little bit. I forgot about all the incentives available to first-time buyers, so appreciate that.
You're welcome.
Next slide. I guess you don't have my next slide.
Maybe somewhere at the end here. You switched over to mine.
While I'm trying to find that slide, it looks like, are you trying to find
one more? You got two more to go, I think.
Someone else is switching my slides. I was confused there. Yeah, thank you, Sean. Appreciate that. And we're going to send out a recording of this tomorrow. So we'll send your details as well. And if anyone has any further questions, they can reach out. We always like to take this opportunity to do a Q&A. So I know I've been answering some questions and Megan from my team has been answering questions. But if you guys have any further questions, please share them. I'd be happy to answer them. In the meantime, I want to invite everyone to an event, an open house we're going to be doing next weekend. My team will be there. There'll be an opportunity to meet with us. We're going to have light refreshments, some snacks. We're going to have an option to tour some beautifully staged suites. So this developer, I've actually bought a number of units in here. One of them I'll be moving into, but I also bought one as an investment. It's Gallery on the Park. They have 3 buildings. The developer still has some remaining inventory. Some of it is ready to move in. Some of it will be ready really soon. But they're offering some incredible incentives that we can't email out and share on this call. But when you guys come and meet us next week, we'll be able to walk you through them in detail. It's a really, really, really good deal. It'll give you an opportunity to ask us any questions. We'd love to meet you guys face to face. We love having conversations and helping you guys navigate the market. So hopefully we'll see you. It's next Saturday from 12 to 2 p.m. Take out your phone, and there's a QR code there if you guys want to register. We'll also send an email. Sean, it looks like we've answered all the questions during the webinar, so I appreciate your time, and I look forward to next time.
Great. Thanks so much for having me, Ryan.
All right, guys, have a great night. Thanks, everyone.